Hello, beautiful people. I am here today to talk to you guys about stocks.
Nothing in this world that I like more than checks. Money. All I really want to see is the money. I don't really need a D, I need the money.
Since you are watching this video, I'm assuming that you either want to learn more about investing, want to get started in investing, or just kind of want to see where you compare to the rest of the world's knowledge with investing. Either way, I'm super glad to have you here. Clearly, this is very serious. That's why I got my little button up on. It's time to talk about money. So as a young adult, building your wealth is extremely important. I think a lot of us are starting to realize now that there is more of an importance to build wealth rather than spend it on things to make it look like you have wealth. I think that is something that I love so much about our current society and the amazing people at my age is that they're learning to develop passive income. They're learning to make side hustles, have multiple streams of income, and work better and use their money better and their time. I will begin with my story really quick. I started investing at the age of 19. You do have to be 18 to start investing under your name. There are multiple things you can invest in. I'm sure you've seen all the Forex people with the currency, day trading, stuff like that. I'm going to talk about a few things that I do not like about day trading, about short time frame stock investing. So when you invest, you want to invest for the long term. A good percent return annually is anywhere from about 7 to 12%. That's really what you want to aim for, a good 10% annual return rate. That's considered great. If you can get up higher, that's considered even better. It's something that you put your money in and watch it grow over a long period of time. This is favorable over just putting it into a bank account or a savings account because the interest rate on your money in your savings account is like 0.01%, if that. And with the way that currency is growing annually, you're actually kind of losing money. I might provide some statistics here so you can see. So this is why it's better to invest rather than just put money into a savings account, because the market has gone up annually. Even during the Great Depression or the 2008 recession, the market has rebounded and increased past that point. Basically, what I think is the best thing to invest in are mutual funds rather than just regular stocks. The reason why I don't like day trading, which is short-term investment, quick returns, is because first of all, you have to pay way more in tax than you do if you have a mutual fund or a stock. You have to pay closer to, 45% if it's like your income reaches a certain point. So if you make $2 million, you have to pay, I think, like a 38% tax on that. Whereas if you held that money and kept it in your investments for around 5 years, you would only pay 10 to 15%. So quick life hack, invest your money for the long term so you pay less in taxes and you end up making more money, because let's say your stocks do really well and you want to pull them out after just 3 months. If you kept that money in for a few years, you would have made even more because the market would have grown. And if you invest smartly into good stocks or good mutual funds with good returns, you will get a very high percentage return, more than you would if you just put it in for a few months. So that's why I prefer stocks and mutual funds to day trading, cryptocurrency, e-commerce trading kind of thing. Real quick about cryptocurrency. Cryptocurrency is definitely a trend. I think it's so fun. I've invested in Dogecoin. I have 100,000 Dogecoins. But the one thing about this is that it's not FDIC insured. This means that if you lose a ton of money, there's no guarantee that you're ever going to get that back. Therefore, cryptocurrency is pretty volatile, but one of the benefits of it is it can't be tracked. So if you buy or purchase something in Bitcoin, which is typically used on the dark web, it can't be traced back to you. That's a lot of information. So quick recap. Day trading, short-term investments, you have to pay more money in stocks and you end up getting less money than you would if you had invested for the long term. So invest for the long term. Secondly, cryptocurrencies are super fun. Like I said, I invested in Dogecoin. I suggest you do the same. During, I think, the past 10 years, it's gone up 1,500%. So that's incredible. However, it's not insured. Most cryptocurrencies are not insured, meaning that there is no way for you to have that safety net if something were to go wrong. Moving on now. So now we've talked about cryptocurrencies and day trading. Let's talk about long-term investing. So you have regular stocks in which you spend, let's say, I don't know, what is it now? $300 or $200 to invest in a Microsoft stock, where you spend $200 for one tiny share of the huge company Microsoft. Now, the things with this is that you own one direct share. You get dividends annually for the companies that do provide dividends. For the companies that don't provide dividends, they use their extra profit to purchase other companies or to fund more wealth growing ventures. What I prefer to do instead over just buying regular stocks, because personally I don't have the capital to just purchase 5 stocks of Amazon, 5 stocks of Microsoft, 5 stocks of Shopify, because I don't have just $3,000 sitting around where I want to spend $1,000 with one company exclusively, because there's also more risk in that. If I can't afford to spend $30,000 investing in a bunch of different stocks, if I put all of my money into one stock, let's say I have $500 or $1,000 and I put all of that into Amazon or all of that into Microsoft, if that goes down, if that drops or crashes, I lose all of that money. You need to have a very well-rounded portfolio in order to ensure that there's some buffering for those highs and lows, especially if you rely on this for part of your income. This is what brings us to mutual funds. My favorite. I tell everyone to invest in mutual funds. Basically, what's so great about mutual funds is you're contributing to a pot. So let's say that I buy 3 mutual funds of Fidelity Blue Chip Growth. That's a mutual fund that I invest in and that I really like. So, okay, I buy whatever it is, 3-5 shares of that. What the group does, so in this case it's Fidelity and it's their Blue Chip Growth Fund. What they do in that fund is they invest all the money that they get from the different people into a bunch of different things. So let's say there's like 10,000 shares, let's just make up a number, 10,000 shares of Fidelity Blue Chip Growth, and I purchase 5, and everyone else buys the rest of that fund. So there's 10,000 shares. Let's say it was for $1 for easy math. So they have $10,000 now. With that $10,000, they can invest into a bunch of different things. So you'll have maybe 200, 300, 400 companies that they've invested into with that $10,000. However, you only spent, in this case, $5. Therefore, you have spread out your wealth, divided it up. You aren't exclusively investing in one company. So if one of the companies does badly, you have a buffer of other companies to make up for it. Mutual funds typically do very well. You have to do your research, of course, but I invest in Fidelity Blue Chip Growth, Fidelity OTC Port, which is another Fidelity one. Also, there is a NASDAQ mutual fund where it follows the NASDAQ index. NASDAQ is a way of determining if the market is going well or badly. So if the NASDAQ is positive, the market's usually on the rise, and therefore most of your mutual funds and stocks should be making money. So that's another mutual fund to look into. And what you have to do when you invest in stocks is you have to look at their return. So you look at the 1-year annual return, 3 years, 10 years life of fund. You look at year to date, so how they're currently doing compared to the market. You can also look at their Morningstar rating, which tells you what experts have rated this fund. So what I look for is low expense, high growth. And that's what I look for on my Fidelity app. So funds that have relatively low cost per share. So one of them is actually Fidelity Select Technology. And I think it's like, oh my gosh, Fidelity should like send me money for doing this. But I think it's like, oh gosh, maybe $10, $20 a share. So if you have $100, that means you get 10 shares, which is pretty good, or 5 shares, which is pretty good. And you look at annual return. So a lot of these low cost, high growth, 5-star rated funds have around a 20% annual return rate, which is very, very good. If you use that money to then take out and invest into other things, you can expand your wealth in your growth portfolio even more. The last type of investment thing I'm going to talk about are bonds. Bonds are very safe. They're very safe in the sense that it's a consistent, reliable income. So let's say I buy a bond from the government for, I don't know, $10,000. And they say, okay, every year we're going to give you back a little bit of your money plus interest, so that overall you have a 4-6% profit after 10 years or whatever it is. So this is a way typically people who don't want that risk or that volatility and who want to ensure that they have consistent income, they will do something like this where they know, okay, yeah, I'll make the potential for profit is set. I won't make any more than that, which means, I won't do as well as some of the mutual funds, which make 10, 15%, 20, 30 even percent per year. I'll just make 6%, but I know I'm going to get this money. And it works for a lot of people, especially people who already have made money and aren't necessarily looking for big growth. Now, one of the other things that you should look into investing in is a 401k. A 401k is a great thing to do when you initially start out investing, especially if the qualifications for this are that you have a job and that you make less than anywhere from 100 to 200,000 depending on your marital status, where you live, etc. The great thing about this is that when you deposit money into your 401k, companies that you work for will usually match that and then you deposit literally double what you put in. You can only put in a certain percentage of your income annually, but they do extremely well. High growth, very well insured, part of the government, very highly recommend. I'm gonna do this when I first get a job. Then once let's say you get a raise or something and you pass that point of qualifications, let's say you start making $400K a year. You can't contribute to the money in your 401k, but you can still move that money around or take it out when you need to. What's so great about it is that it grows tax-free, meaning that you do not have to pay taxes on it, which is extremely, extremely beneficial. You can pull this money out later on to pay for your kids' college without having to worry about paying taxes on the way in. And it's a tax deduction. So let's say I make 100K per year. I put in 20K to my 401k. Now the government can only tax me on my $80,000 of income. And therefore I'm getting a tax break while also saving and making more money because I will have growth per year. So that's something I highly recommend for people who are just getting into the workforce or who are making less than 200K a year if married, and I think it's 120K per year if single. And that's my advice on investing. If you guys like this, maybe I can make a part 2. I'm really passionate about investing, even though I'm pretty young. I've made pretty good profits, and I just want to share that knowledge with you guys. I feel like everyone should work on building wealth, work on being financially stable, financially independent, to have that freedom to do and enjoy their life as they please. So overall, my recommendations: get a 401k, invest in mutual funds, and invest a little, for fun. Like I said, my Dogecoin cryptocurrency, that's definitely for fun. But for the bulk of your money, if you're looking for high returns, lower risk, and even tax breaks, 401k and mutual funds for sure. The bank that I use and that I prefer is Fidelity, because they do not take out a percentage of your profits for lower balances. I'm sorry guys, I've said a lot, but basically look for a bank that has low or no fees annually. Look for good mutual funds with lower cost, lower risk, but high returns, and invest in a 401k. Have fun. Let me know what you guys think. If you want a part 2, I can do a part 2, but this is just sort of the basics of investing. Go get your money, guys. Oh, like and subscribe and comment. Turn on the notifications. Be nice. We're still a young, new YouTube channel. So yeah, thank you guys for stopping by.